Imagine sitting in a sleek, air-conditioned boardroom. You know, you've got a cup of good coffee in front of you.
Right.
And a beautifully designed, like, glossy annual report is slid across this giant mahogany table. It's just packed with uplifting buzzwords, stuff like sustainability, green initiatives, carbon conscious.
Yeah, the classic PR terms.
Exactly. So you flip to the back, you sign on the dotted line, and you smile thinking you've just endorsed this fantastic corporate vision. But what you've actually done by putting your pen to that paper is unwittingly expose yourself to up to 10 years in prison.
It sounds like a dramatic hypothetical, I know. But the legal architecture currently reshaping corporate governance has made that scenario intensely real.
Yeah.
The whole grace period for treating sustainability as just some corporate PR exercise, it is effectively expired.
And that's exactly what we're unpacking in today's deep dive. We are looking at how environmental, social, and governance reporting, ESG, has undergone a really radical transformation.
Radically, yeah.
Because for anyone paying attention, ESG has shifted from a, voluntary marketing add-on to a heavily regulated, legally binding data set. So our mission today is to dig into the nuts and bolts of this shift.
And it's a complicated shift.
It really is. We need to explain exactly how boards must now treat ESG data with the exact same paranoia, precision, and rigor as they do their quarterly financial earnings.
Which is a whole different ballgame for most of these directors.
Totally. And to get there, we're pulling from a pretty intense stack of sources today. We've got legal guides on independent director liability from Lasico, some academic research on management strategies from the Journal of Marketing and Social Research.
Mm-hmm.
We're also looking at environmental court digests from Down to Earth, global compliance data from Pulsora, and some expert strategic notes on board accountability. So a lot of ground to cover.
Yeah, and the overarching theme binding all the sources together is, well, it's that the era of the soft narrative ESG is
Dead and buried.
Exactly. We are now operating in the era of assurable data because historically, corporate sustainability lived in this nebulous space where broad intent and really good adjectives did most of the heavy lifting.
Right, like we're committed to a greener future and everyone claps.
Yes. A metric would appear in the annual report. Maybe a department would supply a number that felt directionally correct, and the board just moved on. To understand why that is suddenly illegal, we really have to trace the regulatory evolution, particularly how it played out in India.
It's a fascinating pivot, too, because corporate responsibility in India historically meant something completely divorced from the current global definition of ESG.
Completely different.
Like for decades, the focus was almost entirely on philanthropy, right?
Yeah, it was entirely philanthropic. We're talking of the Corporate Social Responsibility Mandate, specifically Section 135 of the Companies Act.
Okay, right.
That law essentially required companies meeting certain financial thresholds to carve out 2% of their average net profits, and they had to spend it on social welfare.
Like building schools or something?
Exactly. Building schools, setting up rural healthcare clinics, funding disaster relief. It was this externalized obligation.
Okay, let's unpack this. So CSR was essentially an after-the-fact tax.
Basically. Yeah.
You go out, you run your business however you see fit, you generate your profit, and then you just take a slice of that profit and do something nice with it to clear your conscience.
That's a great way to put it.
But ESG, by contrast, seems to be interrogating the mechanism of the profit itself. Like, how did you make the money in the first place?
Yes, it interrogates the operational DNA of the business. I mean, ESG doesn't care as much about the clinic you built with your profits. It cares about whether the factory that generated those profits is, dumping untreated effluent into the local water supply.
Wow, great.
It asks about your labor practices, your board diversity, your supply chain's carbon footprint. It is an internal accountability mechanism. And the regulatory hammer that really codified this shift in India was the introduction of the Business Responsibility and Sustainability Reporting Framework, the BRSR, by SEBI.
SEBI, the Securities and Exchange Board of India. And the rollout of BRSR is where the trap was really set for a lot of legacy companies, I think.
Oh, absolutely.
Because SEBI introduced it as a voluntary framework first, back in 2021. So it's like a test run. But then, for the financial year 2022-23, they made it mandatory for the top 1,000 listed companies by market cap.
Which caught a lot of people off guard.
I bet. I'm looking at this shift and just wondering how companies handled the sudden whiplash. Because the marketing department can't just pivot to auditing overnight.
No, they couldn't. And that caused massive internal friction. Under the old narrative marketing model, A company might publish this glossy report claiming they had, say, robust water conservation policies.
That's nice.
Sure. The marketing team wrote it, the graphic designers made it look beautiful, and no one interrogated the underlying math. But BRSR demands quantitative evidence.
Hard numbers.
Exactly. It asks for the exact kiloliters of water consumed, the exact tonnage of hazardous waste generated, and the specific breakdown of Scope 1 and Scope 2 greenhouse gas emissions.
But wait, let me push back on this from the perspective of, like, a frustrated executive.
Sure, go ahead.
Why does the specific format of the data matter so intensely? I mean, it's like a teenager moving from getting a participation trophy to facing a grueling, standardized college entrance exam.
That's a really good analogy.
Right. If a company is genuinely trying to reduce its emissions and they put out a statement saying they're committed to a greener future, why is the regulator suddenly demanding a forensic accounting of their carbon?
Because of the money.
Isn't this just more corporate red tape? It feels like we are burying operational leaders in compliance paperwork instead of letting them actually run the business.
I get that frustration, I really do. But the formatting matters because of how global capital markets operate now. We're talking about trillions of dollars being allocated based specifically on this data.
Trillions, really?
Trillions. We are seeing a massive surge in financial instruments like green bonds and sustainability-linked loans. The down-to-earth analysis specifically highlights how infrastructure and energy companies are tapping into these massive pools of global sustainability-focused capital.
Okay, I see where you're going with this. If I'm an institutional investor, right, and I'm buying a green bond, the interest rate of that bond is often tied to the company hitting a specific target, like, say, a 20% reduction in carbon intensity.
Exactly. And you cannot price a multi-million-dollar financial instrument on an adjective.
Right. You can't bank on robust.
Exactly. If the interest rate hinges on that 20% reduction, the investor needs absolute certainty that the reduction actually happened. If the data is based on, like, a rough estimate from the sustainability intern.
Which, let's be honest, it probably was a few years ago.
Oh, absolutely it was. But if it still is, then the financial instrument is built on sand. The standardized methodologies demanded by BRSR exist to prevent market manipulation. You need hard numbers to prevent companies from accessing cheaper capital under false pretenses.
Which brings us to the enforcement mechanism. Because it's one thing for SEBI to ask for hard numbers, but it's another thing entirely to ensure those numbers aren't fabricated.
Right.
And this is where BRSR Core enters the picture. I think this is the part that is fundamentally altering board liability.
It's the game changer. SEBI recognized that self-reporting is inherently flawed when the financial stakes are this high. So they carved out a subset of the framework and called it BRSR Core.
And who does that apply to?
It applies to the top 500 listed companies starting in the financial year 2025-26, and then it expands to the top 1,000 in FY 2026-27.
Okay, but the full BRSR framework is massive. Like, we are talking about something like 140 disclosure items covering 9 distinct principles of responsible business conduct. It's a behemoth.
It's a monster of a document.
So how does BRSR Core narrow that down?
Well, BRSR Core extracts a highly focused list of critical key performance indicators, KPIs, from those 140 items. These are the most measurable, comparable data points, like specific energy footprints, precise waste generation metrics, gender diversity ratios at different management levels.
That's the stuff you can't easily fake.
Right. But the true paradigm shift isn't just the narrowing of the metrics. It is the requirement for independent third-party assurance.
Ah, so we are talking about a statutory audit. But instead of bringing in an accounting firm to verify revenue and expenses, you are bringing in an external auditor to verify your greenhouse gas emissions and water usage.
It is the exact same mechanism. The era of self-certification is just over. An independent third party must trace the company's ESG claims back to primary source data and verify their accuracy.
Wow.
And SEBI expanded this net even further by introducing value chain accountability.
Okay, I have to say, I found the value chain mandate in the sources to be the most operational, terrifying part of this whole framework.
It's keeping executives up at night.
Because for the top 250 companies, they are now required to report on the ESG parameters of their upstream and downstream partners. Like, they're responsible for the people they buy from and sell to.
Yes. The regulation focuses on partners that account for 75% of a company's total purchases or sales. Though, to be fair, there is a 2% de minimis exemption to filter out the absolute smallest vendors.
Still, though, consider the logistical nightmare of tracking that.
Let's play this out. It's a great exercise.
Okay, yeah, let's do it. If I am sitting on the board of a massive Indian retail conglomerate, it is no longer sufficient that our corporate headquarters is a LEED-certified green building, right? And our primary distribution centers use solar power. That's not enough anymore.
Not even close.
Because if our biggest textile supplier, who is a completely separate legal entity, is running a heavily polluting coal-fired operation and dumping toxic dye into a local river, our retail brand has to aggregate and report that supplier's footprint as part of our own value chain.
Exactly. You absorb their risk.
Yeah.
You own that footprint in the eyes of the regulator and the market.
That is wild.
And this is exactly why the strategic communication at the board level has to change immediately. A chair or a CEO cannot treat the ESG team as a side project anymore.
Right. It's not just the HR team doing a beach cleanup.
Exactly. They have to present this shift to the board as the professionalization of ESG. It must be framed as a core governance and supply chain risk issue. It's basically indistinguishable from financial risk management now.
Here's where it gets really interesting, though. There is a mantra from the strategic notes that I want to dwell on because it perfectly encapsulates this new reality. The quote is, "If you sign it, you own it."
Yes, I love that quote.
It's chilling. If you treat ESG like financial reporting, it means the days of passive oversight are gone. You can't just approve a report that says your supplier code of conduct is strictly enforced.
Nope, that won't fly.
You need the audit trail proving how many supplier audits were conducted, what the findings were, and what corrective actions were actually taken.
And the gravity of that mantra owning what you sign brings us to the severe legal stakes. I mean, what happens to the individuals sitting around that mahogany table when the assurable data turns out to be fraudulent?
Right. What's the penalty?
Well, we need to look closely at the Companies Act for that, starting with Section 116(2).
Okay, this is where we get into the real anatomy of board liability. Section 116(2) outlines the statutory fiduciary duties of a director. It dictates that a director must act in good faith to promote the objects of the company for the benefit of its members, employees, the community, and this is the phrase that changes everything, for the protection of environment.
Yeah, that phrase is not a philosophical suggestion anymore. It is a legally binding fiduciary duty.
So if a director fails to protect the environment, they are in breach of their fundamental duty to the company.
Exactly. But the real mechanism for enforcement, the provision that the LAWSECO guide refers to as the nuclear option, is Section 447.
The nuclear option. I love that phrasing. So Section 447 deals explicitly with fraud, which means if a company submits a BRSR report that contains material misstatements, let's say they fabricate their water recycling rates, or they deliberately hide a massive chemical spill in their supply chain metrics, that is no longer just a PR crisis. It is statutory fraud.
Statutory fraud. And the penalties are uncompromising. Under Section 447, fraud is punishable by imprisonment of not less than 6 months, and that can extend up to 10 years.
10 years in prison for a bad sustainability report.
Yes. Furthermore, it carries fines that can be up to 3 times the amount involved in the fraud. It is explicitly designed to be catastrophic for the individuals involved.
But let's look at this from the perspective of an independent director for a second. Because independent directors are usually brought in for their specific outside expertise, right?
Sure.
I might be hired onto a manufacturing board because I spent 30 years in retail banking bringing financial oversight. I am not managing the day-to-day operations. I am not on the factory floor calibrating the emissions sensors.
Right. You're looking at spreadsheets in a boardroom.
Exactly. So how can I be held criminally liable for a fabricated sustainability metric that the management team handed to me?
That is the exact defense that many directors attempt to use. And it is a defense that the courts are actively, aggressively dismantling right now.
Really?
Yes. Independent directors do have a layer of protection under Section 149(12), but it is a highly conditional shield.
What are the conditions?
The section states that an independent director is liable for acts of omission or commission that occurred with their knowledge, attributable through board processes, and with their consent or connivance. Then there's a critical caveat. They're also liable if they have not acted diligently.
Not acted diligently. Wow. That is a terrifyingly subjective phrase.
Very subjective.
So if the executive team puts the BRSR report into the board packet and the board just rubber stamps it without interrogating the underlying data controls, the regulator views that as a failure of diligence.
Precisely. The National Company Law Appellate Tribunal, the NCLAA, has established very clear precedent on this. They have aggressively rejected what legal scholars call the sleeping director defense.
Okay, walk me through the mechanics of that defense. What does a director actually argue in front of the tribunal when they use that?
Well, the director typically argues that they were a non-executive,
Yeah.
that they relied entirely on the information provided by the managing director and the statutory auditors.
Like, hey, it's not my job to check the factory.
Right. They argue they had no day-to-day involvement in the operational area where the fraud occurred. They basically say, look, I am just a finance expert. I have no capability to verify environmental data, therefore I cannot be liable.
And the NCLA rejects that because...
Because if the report was presented to the board, or if it should have been presented to the board under standard governance practices, a director simply cannot claim ignorance.
They can't just close their eyes.
No. The tribunal's stance is that you were appointed to exercise oversight. If you sit in the meeting, receive a report detailing environmental compliance, and ask 0 questions about how that data was verified, your silence is a breach of diligence.
Oh.
You cannot use your lack of operational involvement as a shield for your lack of inquisitive oversight.
That significantly raises the temperature in the boardroom, and I imagine it gets even more precarious when you look at the safety nets directors usually rely on, because the immediate thought of any board member facing personal liability is, well, that is why we have directors and officers insurance.
Oh, D&O policies, yeah.
Right. D&O policies are supposed to pay the legal fees and settlements if a director is sued for a decision they made on the board.
They are. But the Law Seco Guide points out a massive structural gap in how legacy D&O policies are written. You see, many of these policies were drafted long before the BRSR core framework even existed.
Oh, I see where this is going.
Yeah. They generally cover wrongful acts committed in the capacity of a director. However, they frequently contain very explicit, broad exclusions for any claims related to environmental contamination, pollution, or ecological damage.
So, if a class action lawsuit is filed against the board by institutional investors claiming that the company's stock price was artificially inflated by fraudulent ESG disclosures, like a massive greenwashing lawsuit, the insurance company might look at the underlying cause, see that it relates to environmental metrics, and trigger the pollution exclusion clause.
That is exactly the risk. The insurance company says, sorry, this stems from an environmental issue. We don't cover that. Furthermore, many D&O policies exclude coverage for claims arising from regulatory proceedings initiated by government bodies like SEBI.
Wait, really?
Really. So an independent director could find themselves facing a SEBI investigation for BRSR misstatements, staring down millions in potential fines, and their insurance provider could simply deny the claim, leaving the director to fund their own legal defense out of pocket.
I am struggling to see how anyone would agree to serve on a board under these conditions. I really am. If perfection is impossible, if I cannot physically travel to 300 supplier factories to measure their water usage, and my insurance won't cover me if management lies to me, what is the actual mechanism for survival? How do I prove diligence?
You survive by understanding that the legal standard under the Companies Act is not perfection.
Okay, that's a relief.
Yeah, the law does not expect an independent director to personally audit the supply chain with a clipboard. The standard is intense, documented diligence.
So what does documented diligence look like when reviewing, say, a 100-page sustainability report?
It looks like an active skeptical inquiry that is captured in the official board minutes. When management presents the BRSR report, you do not just nod and praise the nice graphic design. You ask piercing, mechanical questions. You ask, who is the specific executive accountable for this greenhouse gas data? What enterprise system generated this number? Before this report was brought to the board, did our internal audit team run a validation check on the methodology?
So you are interrogating the infrastructure of the data, not just the data itself.
Exactly. You demand to see the data controls. And critically, you ensure that the company secretary records your specific questions and management-specific answers in the minutes.
So it's about creating a paper trail.
It's entirely about the paper trail. If management says, we used an automated enterprise platform and had a third party verify the results, that goes in the minutes. If it later turns out management lied and the data was just cobbled together in an Excel spreadsheet by an intern, your documented questions prove you acted diligently based on the representations made to you. That paper trail is your defense.
That is a crucial distinction. It is the difference between passive reception of information and active, verifiable interrogation. But I want to pivot here a bit because we have been spending a lot of time in the theoretical realm of legal liability and boardroom dynamics.
Sure.
We really need to ground the E in ESG. We need to look at what these data failures represent in the physical world, because these aren't just clerical errors on a spreadsheet. These represent actual, tangible environmental devastation.
They do. And connecting the boardroom data to the ground reality is absolutely essential to understanding why SEBI is enforcing this so aggressively now. The down-to-earth daily court digests provide a relentless catalog of how corporate operational failures translate into environmental crises.
Let's analyze a few of these cases, not just as news items, but as case studies in how a company's internal controls fail, because that's what's really happening. Let's look at the situation in Bihar with the Saidpur sewage treatment plant. The state government had to terminate the project director, and the Pollution Control Board levied a massive fine of 1.09 crore rupees against Toshiba Water Solutions.
The underlying failure there was severe lapses in the operation and maintenance of the facility. The plant was consistently failing to meet effluent norms.
And what does that mean for the surrounding area?
It means the untreated discharge was so severe that reports indicated the local river water had become completely unsafe, even for basic human contact. Like even bathing was unsafe.
Now imagine how that situation looks inside a corporate reporting structure, because before that fine hit, Toshiba Water Solutions, or whichever entity was managing the operational data, likely had internal metrics tracking their environmental compliance.
Oh, without a doubt.
So if a board member is looking at a BRSR report, they might see a line item for wastewater management with a nice little green check mark next to it, indicating full regulatory compliance.
And that is exactly where the concept of a material misstatement becomes incredibly real. If a company claims in its annual report that its wastewater management systems are functioning optimally and mitigating environmental impact, while simultaneously the local pollution control board is building a case against them for dumping toxic effluent into a river, the BRSR report is a fraudulent document.
It's a lie.
Yes.
Let's dissect another case from the digest. In the Ramgarh district of Jharkhand, the National Green Tribunal ordered a massive probe into a cluster of sponge iron factories. The complaints alleged that these factories were blanketing the surrounding villages in 400 to 500 grams of coal dust every single day.
Yeah, and for context, a sponge iron factory involves the direct reduction of iron ore using coal. It is an inherently dusty, heavily polluting industrial process if the electrostatic precipitators and emission control systems aren't functioning perfectly.
So how does a cluster of factories manage to cover an entire village in half a kilo of coal dust daily without it immediately triggering internal corporate alarms?
Well, it happens when the operational reality is decoupled from the reporting reality. On the ground, factory managers might be bypassing emission control systems at night to save on power costs.
Oh, wow. So they just turn the filters off.
Happens all the time. But in the corporate reporting system, they might be logging that the emission systems are operational 204/7. When the ESG team compiles the BRSR report at the end of the year, they just pull the falsified system logs.
And the board signs off on a report claiming industry-leading air quality controls.
Exactly. And the down-to-earth digest highlights several other systemic failures that follow this exact pattern. In Bihar, the River Tel, which is a vital natural drainage channel, is facing an existential threat from massive corporate and private encroachments.
Like illegal land reclamation and silting.
Right. It is choking the water flow and causing severe flooding of agricultural land. Then in Raipur, despite the Transport Department claiming strict enforcement, an NGT report found over 80,000 unfit, highly polluting commercial vehicles still operating, just bypassing fitness checks and emitting heavy smoke.
80,000 vehicles. That's incredible. These ground-level realities are the ultimate test of the BRSR framework, really. The regulator's goal is to force the board to look at the Ramgarh coal dust and the Saidpur sewage before the NGT fines hit.
Exactly.
And this brings us to the twin risks that boards are desperately trying to mitigate right now: greenwashing and AI watching.
Greenwashing is the legacy risk, of course. It is the act of overstating, misrepresenting, or just outright fabricating your environmental achievements to present a misleadingly positive ESG profile to the market.
Right, buying carbon offsets but still polluting just as much.
Precisely. But AI washing is a relatively new, highly sophisticated iteration of this fraud that SEBI has recently started flagging.
I am fascinated by AI washing. How does a company fake an AI capability in the context of ESG?
It usually happens when a company is trying to signal to investors that they have modernized their compliance infrastructure. So they'll claim in their prospectus or annual report that they use proprietary AI-driven predictive analytics to monitor Scope 3 supply chain emissions in real time.
which sounds incredibly impressive to a venture capitalist or an institutional investor.
It sounds great, but when the regulator actually audits the tech stack, they find there is no machine learning model at all. The company is just using standard database queries, or worse, manually entering data into an Excel spreadsheet that they have misleadingly branded as an AI platform.
So it is the technological equivalent of putting a fake asset on your balance sheet. You are artificially inflating the market's perception of your risk management capabilities.
Yeah, exactly.
I keep coming back to the analogy of applying for a mortgage. If I apply for a multi-million-dollar mortgage and I give the bank forged income statements and fake tax returns, my application might look pristine.
Sure.
The algorithm might approve the loan based on those forged numbers. But the moment the bank audits the actual cash flow, or the moment of default, the entire house of cards collapses, and I am charged with wire fraud.
That analogy holds up perfectly in the context of green bonds. The capital markets are pricing a company's debt and equity based on its stated ESG risk profile. If a company lies about its climate resilience or falsifies its carbon reduction trajectory, it is artificially lowering its cost of capital.
Which is illegal.
Highly illegal.
Yeah.
It is manipulating the market, taking money based on an operational reality that just does not exist.
Well, we have spent the first half of this deep dive outlining the threat. We have established that the old narrative rules are dead, the BRSR framework demands assurable data, and the legal consequences for signing off on fraudulent metrics are severe.
Very severe.
Now, we need to transition into the solution architecture, because if I am an independent director or a chief risk officer listening to this, I understand the terror. What is the actionable blueprint to actually execute this rigor and protect the board?
The blueprint requires a fundamental psychological shift. You must treat ESG data with the exact same architectural rigor as financial data. You cannot have a metric exist in a vacuum. The strategic notes we reviewed outline a very specific ESG as assurable data framework.
Okay, let's hear it.
For every single metric in that 140-point BRSR report, there must be 4 distinct pillars of assurance in place.
Okay, let's break down those 4 pillars, because this is where the theoretical compliance becomes operational reality.
Pillar 1 is a clear data owner. Every metric must have a specific human being who is ultimately accountable for its accuracy, not a department, a named individual.
Got it.
Pillar 2 is a known source system. Where does this data originate? Is it pulled from an enterprise resource planning system like SAP? Is it coming from automated IoT sensors on a factory floor? Or is it being manually tallied in a spreadsheet?
And I imagine the tolerance for a manual spreadsheet is rapidly dropping to 0.
It is a massive red flag for any auditor, absolutely. Pillar 3 is a control or validation mechanism. What process exists to check the data owner's work before it is aggregated and sent up the chain?
Like an internal audit.
Exactly. And pillar 4, the most critical for an external audit, is the audit trail and evidence storage. Can an auditor look at the final number in the BRSR report and trace it all the way back to a primary source document like a utility bill or a waste manifest?
Let's apply those 4 pillars to a specific example to see how they function under stress, because I want to make sure I really get this. Let's take a metric like workforce gender diversity at the managerial level.
Okay, good one.
So the data owner is the head of HR. The source system is the enterprise payroll and HR management software. The control mechanism is a quarterly reconciliation review conducted by the internal audit team. And the audit trail is the anonymized, time-stamped payroll export data. That is a clean, auditable process.
Perfectly clean. Now contrast that with a complex environmental metric like Scope 3 greenhouse gas emissions from downstream logistics.
Oh boy. This is where it usually falls apart, right?
As always.
Because if the board asks for the 4 pillars on that metric, and management says, the owner is the sustainability intern, the source system is a collection of emails from our various third-party trucking partners. The control mechanism doesn't exist because we just trust the emails. And the audit trail is a shared folder on a desktop.
Right. And that is a catastrophic failure of governance.
It's totally indefensible.
And identifying that failure before the report is published is the expanded mandate of the Audit Committee. Under SEBI's listing obligations and disclosure requirements, the LODR regulations, the Audit Committee's role has been radically expanded.
How so?
They are no longer permitted to just review the nicely formatted final draft of the sustainability report. They are statutorily required to oversee the selection of the independent assurance provider, and they must actively review the raw data infrastructure that produces the metrics.
The LACICO guide provided a highly tactical compliance checklist for directors, breaking down their responsibilities into 3 phases. before, during, and after the board meeting. I want to walk through this because it provides a literal script for directors trying to establish their diligence defense.
Yes, the before phase is about breaking the habit of last-minute reviews. A director must formally request the draft BRSR report, along with the underlying data methodologies, at least 7 days prior to the board meeting.
Because reviewing a 150-page technical document the night before is functionally impossible and demonstrates a lack of care.
Exactly. During this review, you are specifically scrutinizing the BRSR core KPIs and comparing them against historical data. You are hunting for anomalies.
What constitutes a red flag anomaly when you are scanning year-over-year ESG data? Like, what jumps out at you?
You are looking for numbers that defy operational logic. If a manufacturing company reports a sudden, unexplainable 40% drop in water consumption, but their overall production volume increased, and there is no record of a massive capital expenditure on a new water recycling facility,
Yeah, that doesn't add up.
that data is highly suspect. Water consumption doesn't just spontaneously plummet in an industrial setting. Either the measurement methodology changed without disclosure, the baseline data from the previous year was wrong, or someone in the facility is manipulating the current sensors to meet a management target.
So if you spot that anomaly 7 days out, what happens during the actual board meeting?
During the meeting, you must interrogate management on that specific anomaly. You ask them to explain the operational driver behind the 40% drop. You ask to see the methodology. If management becomes defensive, or if they resist the idea of bringing in an independent assurance provider to verify the drop, that is a secondary red flag.
And crucially, you instruct the company secretary to record your questions and management's rationale in the official minutes.
That is the most important step. And then there's the after phase.
Right, what happens after the meeting?
The after phase is about maintaining your own archive. You follow up on any open items or promises management made during the meeting, and you keep a secure personal record of all the ESG documents, draft reports, and minutes you received.
So you have your own backup.
Yes, because if a regulatory investigation happens 3 years later, you need immediate access to the documents that prove you asked the right questions at the right time.
I want to highlight a specific tactic from the strategic notes that I think is brilliant in its simplicity. They call it the 48-hour practical move.
Oh, love this one.
It is designed to cut through months of theoretical consulting and instantly expose a company's data vulnerabilities.
It is an incredibly effective stress test. A director, or the chair of the audit committee, instructs management to produce a one-page map of the current year's critical ESG disclosures within 48 hours.
Just 48 hours.
Yes. For every key metric, management has to identify the data owner, the source system, the internal and control, and the plan for external assurance.
The genius of the 48-hour deadline is that it prevents management from spinning up a new project to fix the gaps. Like, they don't have time to hire consultants to clean it up.
No time at all.
It forces them to report on the infrastructure as it exists right in that moment. And because they only have 2 days, the weak links become immediately painfully obvious.
The gaps usually hide in the handoffs. It is the space between the facility manager who jotted down a waste metric on a clipboard, the regional manager who put it into a spreadsheet, and the sustainability officer who assumed the regional manager verified the underlying clipboard data.
And the mapping exercise exposes that.
Yes, it forces the board to see that the entire multi-million-dollar compliance report is resting on an unverified clipboard.
So what does this all mean? If you are listening to this and you are sitting on a board, or you are a senior executive tasked with presenting this data to a board, or even if you are an institutional investor allocating capital, this is your immediate takeaway. Run the 48-hour mapping exercise.
Absolutely. Run it today.
Pick 3 random high-stakes metrics from your company's latest sustainability report. Say, Scope 2 emissions, water recycling rate, and supply chain audit coverage. Ask the management team to name the owner, the system, the control, and the audit trail for those 3 specific numbers. If they stumble, or if the answer involves a manual spreadsheet, your organization is carrying massive, hidden legal risk.
It is a vital exercise because the pressure to produce assurable data is not going to ease. In fact, it is going to accelerate.
Yeah.
To truly grasp the magnitude of this shift, we cannot just look at India's BRSR framework in isolation.
Right, because business is global.
We have to expand our lens to the global regulatory landscape. Capital markets are borderless, supply chains are borderless, and the regulatory net that governs them is rapidly becoming borderless as well.
This is where the Pulsora data on global compliance becomes critical. If you are a large Indian multinational or even a mid-sized company exporting to global markets, SEBI is only one piece of the puzzle. The incoming wave of global regulations is staggering in its complexity. Let's look at the European Union first, because they are really setting the most aggressive pace with the Corporate Sustainability Reporting Directive, the CSRD.
The CSRD is a monumental piece of legislation because it mandates a concept known as double materiality.
Okay, explain double materiality because that sounds intense.
It is. Historically, financial reporting only cared about single materiality. How do external factors like climate change or carbon taxes impact the financial bottom line of the company? Double materiality forces a company to report on that, but also to comprehensively report on how the company's operations impact the external environment and society.
So it's a two-way street of intense disclosure.
Exactly.
And the jurisdiction of the CSRD extends far beyond the borders of the EU, right?
Absolutely. If an Indian multinational has significant operations, subsidiaries, or generates a certain threshold of revenue within the EU, they are going to be caught in the CSRD net. They will have to report their global operations to EU standards.
And while the U.S. Securities and Exchange Commission has been kind of bogged down in political and legal battles over their federal climate disclosure rules,
Yes.
individual states are stepping into the void, which creates an even more fragmented landscape.
Yes.
California's Senate bills 253 and 261 are prime examples.
California's legislation is incredibly aggressive. If you are a public or private company doing business in California, and doing business is defined quite broadly there, and you have over $1 billion in global revenue, you are mandated to report your Scope 1, Scope 2, and crucially, your Scope 3 value chain emissions.
Scope 3, too. That's huge.
It doesn't matter if your headquarters is in Mumbai or London. If you sell into the California market at that scale, you fall under the disclosure laws.
Add to that, the UK's mandatory rules align with the Task Force on Climate-Related Financial Disclosures, Australia phasing in mandatory climate reporting align with the International Sustainability Standards Board, and nations like Japan and Singapore making disclosures mandatory for listed issuers.
It creates an unprecedented interoperability challenge.
I can't even imagine the paperwork.
An Indian multinational might have to compile ESG data that satisfies SEBI's BRSR core, the EU's CSRD double materiality, and California's Scope 3 mandates simultaneously. Harmonizing that data across different regulatory definitions, different assurance standards, and different reporting timelines is an absolute nightmare.
So let's talk about the mechanics of solving that nightmare, because you cannot solve a multi-jurisdictional data harmonization problem with 1,000 Excel spreadsheets being emailed back and forth between regional offices. Human error alone would result in massive compliance failures.
No, it requires a wholesale transformation of a company's data architecture. Companies are being forced to abandon legacy manual processes and adopt enterprise-grade ESG data platforms. These systems have to be capable of real-time tracking, automated benchmarking against multiple global frameworks, and integrating directly with the company's core financial ERP systems.
We are seeing the integration of highly advanced technologies to create that necessary audit trail. Some supply chains are using blockchain ledgers to trace the origin of raw materials, like cobalt or cotton, from the primary extraction site, through multiple processing tiers, all the way to the final product.
Right, to definitively prove no forced labor was used and environmental standards were met.
Exactly. We are also seeing the use of satellite imagery and geospatial analytics to verify land use claims, ensuring a company isn't claiming a zero deforestation supply chain while their Tier 2 suppliers are actively clearing protected forests.
The technology is necessary, but the LawSeco blog offers a profound warning about the careless implementation of technology, particularly concerning artificial intelligence.
Oh, this is the AI washing part.
Well, it's AI risk in general. In the rush to process massive amounts of unstructured ESG data-like reading through hundreds of 300-page supplier code of conduct reports, there is a massive temptation for executives to simply dump those documents into consumer-grade AI chatbots and ask for a summary of the emissions data.
I can completely see an overworked sustainability officer doing that at 2 a.m. to hit a reporting deadline.
It happens constantly, and it is a massive governance failure. If a director or a management team feeds confidential pre-publication board data or proprietary supply chain metrics into a public AI model, they are actively breaching data privacy and confidentiality protocols.
Wow, yeah.
They are essentially leaking material non-public information to the AI's training set.
Not to mention the risk of the AI simply hallucinating the data.
That is the secondary, equally dangerous risk. If you rely on an AI-generated analysis of supplier emissions, and the AI hallucinates a favorable carbon reduction trend that the board then incorporates into the BRSR report, you have just committed a material misstatement.
So you're back to Section 447 and fraud.
Exactly. Using unverified AI outputs as the basis for a legally binding regulatory filing is the absolute antithesis of diligence. Any technology deployed for ESG reporting must be secure, enterprise-grade, and its outputs must be subjected to rigorous human validation before reaching the board.
I want to address a specific segment of our listeners right now. If I am listening to this and I am the CEO of a mid-sized manufacturing company, maybe we make specialized auto parts, or we are a mid-tier textile dyer and we are not publicly listed, we are nowhere near the top 1,000 market cap threshold.
Okay, right.
We don't fall under SEBI's BRSR mandate and we don't operate in Europe or California. Why should I spend a single rupee upgrading my ESG data infrastructure right now? Can't I just ignore this entirely?
You might not be regulated by SEBI directly, but you are regulated by your customers. And that is often a much swifter and more brutal enforcement mechanism. This is the trickle-down effect of global ESG regulation. Remember the value chain reporting mandate under BRSR Core?
Yeah.
And the Scope 3 requirements in California and Europe?
The requirement for the massive enterprise companies to report on the emissions of their suppliers.
Exactly. If you are that mid-size auto parts manufacturer and your biggest client is a massive, publicly listed automotive conglomerate that falls under BRSR Core, or CSRD, they are legally mandated to calculate the carbon footprint of the parts they buy from you.
So the regulatory burden flows directly down the supply chain. The massive conglomerate cannot fulfill its legal obligations unless I, the mid-sized supplier, provide them with my granular, assurable ESG data.
And if you cannot provide that data, if you tell the massive conglomerate that you don't track your energy usage or you just send them a rough estimate on a spreadsheet, they cannot use that data in their audited BRSR report.
Which means they fail their audit.
Right. They will not risk a SEBI fine or a shareholder lawsuit to protect a mid-tier supplier. They will simply be forced to drop you from their vendor list and award that lucrative contract to a competitor who has the data infrastructure to provide assurable metrics.
That's ruthless.
ESG compliance is no longer a niche differentiator. It is rapidly becoming the baseline cost of entry for participating in global enterprise supply chains.
That is the ultimate reality check. It isn't just about avoiding prison time for the board. It is about the fundamental commercial survival of the business. If you cannot produce the data, you cannot access the market.
That's the bottom line.
Let's pull all of these threads together and summarize the monumental shift we have dissected today. The narrative is clear. ESG is no longer a marketing exercise. It is no longer a collection of aspirational goals managed by the PR department. It is hard, assurable, legally binding data.
The regulatory frameworks, spearheaded by mechanisms like BRSR Core, demand audit-level precision. The days of passive board oversight are definitively over. The legal standard demands intense, documented diligence, forcing directors to interrogate the infrastructure of the data they approve.
The mantra that should be echoing in every boardroom is, if you sign it, you own it. Every sustainability metric published by a company must be supported by the 4 pillars: a clear data owner, a verified source system, an internal control mechanism, and an unbroken audit trail.
If a company's internal ESG controls cannot withstand the same level of scrutiny as their financial reporting standards, they are operating with massive, unmitigated risk.
As we wrap up this deep dive, there is a concept that builds on everything we've discussed. A potential future scenario that I want to leave you, the listener, to mull over. We have established that ESG data is becoming just as regulated, standardized, and legally binding as a quarterly financial earnings report.
Right.
Given that reality, how long will it be before we see the rise of the specialized ESG short seller?
Oh, wow. It is a chilling but entirely logical evolution of the market. We are actually already seeing the beginnings of this. Imagine activist hedge funds deploying sophisticated web scrapers, satellite imagery analysis, and supply chain forensic algorithms specifically designed to sniff out corporate greenwashing.
They wouldn't be looking for a financial accounting fraud. They would be looking for sustainability accounting fraud.
Precisely. They will seek out companies that have a massive disconnect between their glossy, narrative-driven marketing and their actual assurable operational data. They will find the companies relying on manual spreadsheets and unverified supplier emails. And when they find that structural weakness, they will build a massive short position against the company's stock.
And then they publish the forensic report, exposing the fraudulent BRSR filings to the market and the regulators simultaneously.
They will turn a company's hollow environmental marketing into the weapon of its own financial destruction. When ESG data is legally binding, the market will inevitably build mechanisms to violently correct the valuation of companies that lie.
The margin for error has vanished. When you are sitting in that boardroom and that glossy report is slid across the table, you are no longer endorsing a vision. You are attesting to a heavily regulated data set. You better know exactly what is in the numbers before you pick up the pen. Thank you for joining us on this deep dive into the new realities of corporate governance. Keep interrogating the data, keep demanding the audit trails, and keep pushing for clarity in your own organizations.